One narrow stretch of water, barely 21 miles wide at its tightest point, carries roughly a fifth of all the oil traded on the planet. And right now, Iran has just raised the threat level there to severe. If you fill up a car, heat a home, or own a single share in anything connected to energy, this story affects you directly. Here's what's happened. Navy. Tehran has now issued a direct warning. Any ship that does not use a northern passage specifically approved by Iran risks being targeted. That's not a diplomatic suggestion, it's a military ultimatum delivered to the entire global shipping industry. The message is blunt. Use our route or face consequences. And given that attacks on tankers have already occurred, the threat carries real weight. To understand why this matters so much, you have to appreciate what the Strait of Hormuz actually is. Picture a narrow bottleneck between the Persian Gulf and the Gulf of Oman. On one side you have Iran, on the other, Oman and the United Arab Emirates. At its narrowest, the navigable channel is just a few miles wide, and through those few miles flows an extraordinary share of the world's energy supply. Roughly a fifth of global oil trade passes through here. That includes massive volumes from Saudi Arabia, Iraq, Kuwait, the UAE, and Qatar. Qatar, for instance, is one of the world's largest exporters of liquefied natural gas, LNG, and virtually all of it leaves through the strait. So when Iran talks about controlling who uses which route inside that corridor, it isn't posturing about a minor waterway. It's asserting leverage over one of the most critical choke points in the entire global economy. Navy has long operated in this region, helping to escort commercial vessels and maintain what Washington calls freedom of navigation. Iran's decision to attack ships using the Navy's preferred route is a direct challenge to that presence, and a signal that Tehran is willing to escalate. So how does this actually work in practice? How does Iran's threat translate into real disruption? Let's walk through the chain of events that follows a move like this. First, shipping companies have to make an immediate risk calculation. When a government raises a threat level to severe and has already demonstrated willingness to use force, insurance underwriters respond almost instantly. War risk insurance premiums on vessels transiting the strait spike. Shipping companies then face a choice: pay the higher premiums and keep sailing, divert around the Arabian Peninsula, which adds days and significant fuel costs to a voyage, or simply wait. Most major operators don't wait long before they start rerouting or reducing traffic. Second, oil and LNG cargoes that were expected to arrive on a certain schedule start getting delayed or canceled. Buyers on the other end, refineries in Europe, importers in Asia, begin drawing down their strategic reserves or scrambling to source supply from elsewhere. That tightness in supply, even if it's temporary or partially psychological, tends to push prices upward. Third, there's the geopolitical feedback loop. Navy's preferred corridor is specifically targeted. Washington faces pressure to respond, either by increasing its military presence, convoying vessels, or applying diplomatic and economic pressure on Tehran. Any escalation on that front creates further uncertainty, and markets generally don't like uncertainty. It's worth noting, too, that Iran has done versions of this before. Military started escorting Kuwaiti tankers under American flags to protect them. History doesn't repeat exactly, but it does rhyme. Now let's talk about impact. And this is where the story gets truly global. The most immediate effect is felt in energy markets. When the Strait of Hormuz is perceived as unstable, oil prices tend to reflect that anxiety relatively quickly. Traders price in what's called a geopolitical risk premium, an extra cushion above the fundamental supply and demand price, because nobody wants to be caught short if supply actually gets cut. Higher oil prices don't stay in the energy sector. They ripple outward. Transportation costs rise, which pushes up the cost of moving goods of every kind. Europe and Asia are still sensitive to after the inflationary period of recent years. For LNG specifically, the impact can be acute for countries in Asia, Japan, South Korea, and others, that import the vast majority of their gas and have limited ability to quickly switch to alternative suppliers. Europe, which spent years diversifying away from Russian gas, has become more dependent on LNG from the Gulf region. A prolonged disruption to that supply lane would put real pressure on European energy security. There are also second-order effects on financial markets more broadly. Energy stocks tend to react in complex ways. Oil producers may benefit from higher prices, while energy-intensive industries take a hit. Shipping stocks and tanker operators find themselves caught between higher revenues from elevated freight rates and the very real operational risks of transiting a war risk zone. And for emerging market economies that import oil, countries across South Asia, Southeast Asia, and Sub-Saharan Africa, a sustained price spike can be genuinely destabilizing, draining foreign exchange reserves and widening trade deficits. The severity here isn't just about barrels of oil. It's about the web of dependencies that modern industrial civilization has built around the assumption that this one small waterway will remain open. So, how do we classify what's actually happening here? This is a geopolitical supply shock in the making. Not yet a full disruption, but an active, escalating threat to one of the world's most critical energy choke points. Iran's move has several layers. At one level, it's a tactical assertion of territorial and maritime authority. Tehran is essentially saying it has the right to dictate shipping lanes inside a corridor that international maritime law has traditionally treated as open to all. At a deeper level, it's a strategic signal, almost certainly connected to the broader tensions between Iran and the United States. Tensions that have fluctuating intensity depending on where nuclear negotiations and sanctions policies stand at any given moment. And at a market level, it's a reminder of something investors and policymakers sometimes forget during quiet periods. The global energy system has vulnerabilities that no amount of financial engineering fully insulates against. Energy Information Administration, and moments like this one illustrate exactly why that designation exists. And Gulf states respond militarily and diplomatically, and whether shipping companies decide the risk is manageable or not. Each of those paths leads to a different outcome for energy prices, inflation, and global growth. The situation is live, it's escalating, and it deserves serious attention from anyone who follows global markets. If you found this breakdown useful, subscribe to Investors Club Global. We cut through the noise on exactly these kinds of market-moving events every week. Hit the like button if this helped you understand the story, drop your thoughts or questions in the comments below, and share this with anyone who needs to know why a narrow strip of water on the other side of the world matters so much to all of us.